Hello and welcome back to Southbank Live. Here we are with episode 28, and in this episode we have a very special guest. This is Akhil Patel joining us today this evening. Akhil, welcome to the show. We have plenty to discuss. I thought maybe just to begin with, you could give us a little introduction with what it is that you do, your proficiencies in economics, and then we can go into some of the very interesting stuff regarding your grand cycle theory.
Well, thank you very much, Boaz, for having me on the show. And it's really good to reconnect after what has been quite an interesting couple of years. Just a bit about me in terms of what I do. I am the director and co-founder of a consultancy stroke subscription service called Property Share Markets Economics, where we produce commentary on the economic cycle, the stock market, commodities, and so on. I also work part-time for an international development bank headquartered in London. And the third arrow in my quiver, shall we say, is I'm currently writing a book where I'm setting out, in detail how the cycle works and most importantly, what investors can do about it. So that's me. Now, I specialize in talking about the 18-year economic cycle. You call it the grand cycle. I think that's a very apt description. And it's essentially a cycle that takes economies through periods of boom and bust. Typically, it's 14 years of an expansion interrupted by a mid-cycle slowdown and 4 years of pretty significant crisis, an economic depression, banking bailouts, a lot of economic and political turbulence. And that typically takes 4 years to complete, and then the cycle is reset and it starts again. And the cycle in the US and the UK has been going on for about 200 or 250 years. So it has a very long historical significance. And if you read history through this lens, you can trace the cycle quite clearly.
Indeed. Now we will dive a little bit further into sort of the history of the cycle, and I'd like to explore actually a bit how it's been suppressed throughout history, because it's somewhat dangerous information considering what its consequences are, and what it means. But just to wind back a little bit, this is our 28th episode. If you have been enjoying these shows, do give us a like and subscribe, please. Or if you are, and indeed if you are watching the show, great and hearty welcome to you for joining us, because it is very good to have a live conversation with our viewers. We do have a few folks in the chat. Good evening to you all. And indeed, we have some questions from the chat as well, which we shall be getting onto later on this evening. But Akhil, originally when we first got to know each other, I was quite skeptical of some of the radical ideas that you proposed. Though over the time that we've known each other, I've been thoroughly turned around to your way of thinking on several things. I thought we could start just a little bit with the 18-year cycle. It all comes down to land. Is that correct? That's where things really begin, and how land prices ultimately affect so many other different prices in the economy, and also in a way create the boom bust cycle that we have. So I thought we could just start there a little bit, and then we can delve deeper into some of the consequences and what investors can take away from it.
Yeah, I mean, so as you say, land is an economy's most fundamental asset. So everyone needs a place to live, and every business needs a place to locate. So it's fundamental. It's unavoidable. You either have to buy it and own it, or you have to rent it. Now, because land is fundamentally scarce, and certainly land in good locations where people want to live and do business, it ultimately takes the surplus of all economic progress. When I say surplus, I mean the windfall gains as societies grow, as technology improves things and improves productivity. And because land takes all of that gain ultimately, it makes it an extremely valuable asset, and an asset that people like to speculate in and like to secure borrowing against, which drives things up over the top. So, when your rents go up too much, when you have to pay too much interest on your mortgage, you cut back on other expenditure, that sort of generates a recession. And when that happens, people stop spending, property prices come down, but really what it is land prices are coming down. And when that happens, when it's banks have lent too much against land, against property, then that brings down the banking system, which means that businesses don't get the credit they need to continue functioning. So then they lay off workers and you get a major recession. So that's basically why land is so fundamental to the cycle, and why some people call it a property cycle, but it's kind of, I think it's really an economic cycle. Now, there was an economist in the late 19th century by the name of Henry George, who wrote a book called Progress and Poverty. And in it, he set out two main aims. One was to ask the question, why do we keep getting these periods of boom and bust? He was an American, so writing about the American economy. And, as I said, it's a cycle that's been going on for over 200 years. So since 1798 in the US, and he was writing in the 1870s. So for almost 100 years, why has it been going on? And then the other question was, despite all the amazing progress that the American economy was experiencing, so if you think back to the 19th century, the settlement of the entire sort of continent of the United States, the amazing kind of innovations that came out of the railroads, and heavy industry and so on, is creating enormous prosperity. But at the same time, there was sharply the society was getting sharply divided between those who owned land and those who didn't. And he wanted to understand why that was happening. And he, discovered the land cycle, essentially. And he then said, well, the reason that land goes up in value ultimately is because there's a lot of public investment, and societies are growing and people are getting more prosperous, and therefore they're bidding up the price of land. And that value is created through public investment. And so actually that's what should be ultimately the basis of taxation. That public investment is drawn back into the public purse. And actually you shouldn't be taxing people's wages and business profits, because that's private value creation. And so the tax system should basically be turned around. Well, it just so happens that the most influential and powerful and wealthiest people in society own all the land, and they didn't really like this idea. And Henry George, unfortunately for him, was fortunately for him, but unfortunately for the vested interests, was extremely popular, because clearly this explained what was going on in not only in America but also in the UK, and you could start to see the emerging sort of system of boom and bust in Australia. And so he was running up against vested interests all over the place, and he was very influential on progressive politicians in the UK. So the Liberal Party adopted his idea in the early 20th century, and it was actually championed by people like Churchill, who at the time was a Liberal MP, and also David Lloyd George and Gladstone and others. And once it was a serious proposal on the table, it had to be stopped. And so in the UK, the House of Lords voted down the budget of 1909, which created a constitutional crisis, because the House of Lords not supposed to stop money bills. In the US, they had a slightly more insidious way of stopping George. They effectively took land out of the economics discipline. So people talk about labor and capital, but they never talk about land in terms of economic kind of analysis. And the reason for that was there were a number of economists in the early 20th century who basically claimed that land was a form of capital and therefore didn't need to be treated in its own right. And therefore, it was never seriously proposed as a solution to boom and bust, which is essentially why no expert can really understand the cycle, because they can't diagnose it properly. They can, of course, understand that sometimes banks lend a bit too much money for property, and they can see property prices rising, but they don't fundamentally understand why this is central to the economic cycle, and why when it goes over the top, you get a major banking crisis. And they don't see it happening in 18-year phases. And so, unfortunately, as the Queen asked when she went to LSE in 2008 and said, well, why did no one see it coming? Yeah. They were able to give lots of answers about Chinese saving so much and pushing bond yields down, and lots of risk taking, but no one really understood who was managing that risk, and all these sorts of issues, while important, weren't fundamental to the answer. So this is why no one sees the cycle.
Yeah, symptoms rather than the root cause. The Henry George story I find fascinating, because it's in the economics profession, I'm not university educated or anything, but just in terms of economic discourse that you see regarding that what drives boom and bust, you don't hear anything about Henry George. He's effectively been written out of history to a large part. It's only through yourself that I'm familiar with him, and yet at the time he was one of the best-selling non-fiction writers of his time, right?
Well, it's said in the last decade, or maybe last 2 decades of the 19th century, the only book that sold more copies was the Bible. And I mean, I mentioned he was very popular. He was very influential all over the place, and it wasn't just in the Anglosphere. I mean, he was very influential in China, Sun Yat-sen, and other people like that. He was influential in Russia. So Tolstoy was a big advocate. Einstein also in Germany. So he, I think even now, if you were to count all the sort of copies sold of all these various economic textbooks, talking about Samuelson's really famous textbook that came out in 1948, probably Henry George, even after a century of obscurity, is probably the most widely read. So it just goes to show how successful the I don't know what the word is, but counterattack was against his ideas, because it went up against such influential interests who didn't want to see his solution enacted. And it's very short-sighted, because the alternative in Russia, for example, was a much darker revolution, which was much more problematic. Whereas really the Georgist solution is ultimately freeing the free markets to do what it does best, which is to allocate resources efficiently and provide the right incentives to do so. Unfortunately, we live in a system of land monopoly.
Yeah, which goes into another story that you told me about, which I'd never heard of before, with the game of Monopoly originally being proposed and delivered as a example of how the current economic model that we have doesn't work, rather than as a fun family game, and then proposing an alternative to it, which involved land. Some of those interesting things where you referred to earlier about factors of production, where today, if you're reading The Economist or whatever, not to bash The Economist too much. If the economy is presented as a combination of the factors of production being labor and capital, and capital has been privileged very heavily in recent years, and labor has not, and that's why we have populism. And it's very reductive how things are brought down to labor and capital, when in reality, land has a huge influence on this, but it's just something that's not spoken about so much. Because when you're talking about land, people have various ideas of it. Often they think agricultural land, or they think of these places where they're going to build huge new hamlets and villages out in the countryside and things like that. But actually, it's the effect of the land cycle can be felt pretty much everywhere, and it's especially it's especially concentrated in big metropolises like London, though you would never hear it referred to in that way. We do have some good questions in the chat here. I thought maybe we could take a couple of them here before we go into where we're headed in the cycle in general. Andrew says, "Hi, Boaz. Hi, Akhil. Good evening to you, Andrew. Thank you so much for joining us." And indeed to Saw VTI, says, "Hi, all. Very good evening to you too." We do have a question on demographics from Jason. Is demographics not a big factor of the economic cycle as well, Akhil? Could you comment on that?
Yeah, well, wherever people are moving to, that's where land prices go up. So you have big demand for a scarce asset, and it's not just population growing in absolute sense. It's also people moving from one city to another, and where they're moving to, prices go up, and things can go over the top. And when things go over the top, it can start to bring the banking system down. So it's a factor, but it's it needs to be seen in that context.
Arthur Schopenhauer, I doubt, maybe not his real name, is asked a question. So a presupposition of Akhil's theory is property right, brackets, or is it? What happens when totalitarian and oppressive governments take over? Does the cycle continue? It's a great question. So, Akhil, in places where communism, or even there aren't any property rights, where it's really much less developed, and the rule of law is mostly replaced by the rule of man. Does the cycle still express itself? Can this really be found anywhere where there is economic activity, or is it something that is maybe more unique to sort of Western liberal societies where property rights have been, instilled and are upheld by the law?
Yeah, I mean, there's quite a lot in this. So I'll just try and keep it relatively simple. I mean, property rights, the key bit about property rights in the West is security of tenure. So if you have the right to occupy it. No one comes and takes away. It's not absolute ownership to do with as you will. That is a kind of a element of fantasy that has come in to justify the current system that we have. And of course, we've exported it all over the place with some pretty horrendous consequences. Now, in communist regimes, I mean, if you can't speculate in real estate and create credit, bank credit against it, then you're not going to get the boom and bust cycle. But you are still nevertheless going to get a build-up of economic rent, which at some point will be exploited. If the land is all controlled by the government, it gives government enormous power over its citizens. So essentially, in any society, in any system, whoever controls the land effectively controls a society. And that actually, you mentioned the game of Monopoly. That is the ultimate message of Monopoly. So it was invented by a suffragette in the early 20th century. She created this thing called the landlord's game with two sets of rules. The first one, the set of rules that we are more or less familiar with through the game of Monopoly that we play. And then a second set of rules where you actually just tweak the system slightly. You had the same kind of ideas, but everyone would pay a ground rent into the public purse, which then became the fund through which you increasingly had free utilities and free education and so on, and no one could bankrupt anyone else. That's basically the system Monopoly, the game of Monopoly as it should have been. But she pointed out that whoever ends up controlling the land controls society, and that's true whether in a Western capitalist system or in a communist totalitarian system as well.
And more recently, we've been getting predictions that in in the 2030s, you'll own nothing and you'll be happy. I think that was from the Davos crowd, which got many people very incensed, and rightly so, back in 2020. It does feel like when you were talking about how Henry George came up with this in an environment when wealth inequality ultimately was very much on the rise. Here we are again today, Akhil, and wealth inequality is very much a thing, and it now gets talked about more and more and more. So this kind of these kind of economic theories, maybe they get turned to a lot more. Do you think this is something that, while it has been misunderstood for so long, this is going to really catch the public interest and maybe change policy in the future?
Well, I mean, it's undeniable that inequality and housing inequality and wealth inequality is a really big political issue. I'm not seeing many solutions proposed that follow Henry George's ideas, and I'm not seeing many analyses on that way. So one example is the 2014 book by Thomas Piketty, the French economist, who amassed an amazing data set for over 100 years, pointing out how returns to capital have basically explained most of the increase in inequality. And it took an MIT student to actually then say, well, most of what you're seeing as returns to capital is actually returns to housing. And so, many critiques of capitalism exist, but they are almost co-opted into the same short-sighted way of viewing things because they treat land as a form of capital. And so they almost buttress the system that we have as it is now, not as the system that we should have. And ultimately, inequality can't keep going up and up. At some point, those who have the least have the most interest in throwing the system over. And when you get revolution, who knows where that goes? It often, rarely ends well, at least not in the short term. So that's a warning. Whether that's going to happen in the next decade or in 20 or 30 years, it's got to happen at some point without some more sensible reform.
Well, Akhil, you got my vote if you do decide to stand and change things for yourself. We have received some great questions in the chat, which we shall return to in a little bit. But I think it would be good to bring things very much into the present with where we are in the 18.6 year cycle. I believe we have a very nice slide that Akhil has prepared for us, which we could take a little look at. Yeah, Akhil, could you tell us what we're looking at for folks who are new to your theories, and then we can go into where we are and what it means.
Okay, and now I should point out that I'm not the originator of the 18.6 year idea. I mean, I mentioned Henry George. He analyzed the land cycle, but it was actually a Chicago economist by the name of Homer Hoyt in the early 30s during the Great Depression who amassed he gathered together all the data on Chicago land prices from about 1830 and discovered four great 18-year cycles in Chicago, which, once people started looking into it, they found was all over the US. And then English economist Fred Harrison in the 70s resurrected Hoyt's thesis and applied it to the UK and to other countries. So I just want to make that clear. So what we have is, I mentioned it was an 18-year cycle, 14 years up, so and interrupted by mid-cycle slowdown. So you can see two 7-year highs effectively, with the blue line in the middle. That's the mid-cycle slowdown, and then a much bigger second half, which accelerates into a peak. The last kind of acceleration is roughly 2 years of proper madness and mania, and then a major crash at the end, lasting sort of 4 years. Not necessarily just crash for 4 years, but 4 years of difficulty and problems in the banking system and the high unemployment and people not being able to get much done, completing the 18-year cycle. So that's essentially an illustration of the overall sort of structure of the cycle. The current cycle started around 2011, 2012. It's, there's no one day or 1 minute when the cycle starts. You just kind of have to look for the turn. It's usually some major blowout event or major scandal emerging or something. So I'd say, the Eurozone crisis in 2011, the Draghi statement in 2012, whatever it takes, the LIBOR scandal that emerged in that year probably was the final act of the previous cycle. Then we had 7 years up into 2019. The cycle ran on a little bit to 2020. Notice how at the start of the pandemic, everyone was saying, well, this is the worst crisis since the Great Depression, or in the UK, the biggest recession in 300 years. Of course, it wasn't, because we weren't having a falling land market. Banks hadn't over-created credits during the first half of the cycle, so we didn't have a banking crisis. And actually, the recovery has been rather swift. We're now one or 2 years into the second half of the cycle, and we should have a peak 7 years after the midpoint, so around 2026, and completing a 14-year expansion, and that's when the crash will happen. And it generally is the case that the bigger the boom, the bigger the bust. Alongside where we are now, what you tend to see is banks really creating money, and as if there's no tomorrow. So an era of very easy credit. So we haven't really seen that yet, but it's starting. You tend to get an infrastructure boom because there's a lot of public investment. It's a typical response to the mid-cycle recession by governments. We're having it now. We got it in after 2001. That pushes commodity prices up. Wherever infrastructure goes in, that pushes land prices up. This businesses and households are drawn to those places, pushing up prices even further. Banks are only too happy to lend to new areas, which is not the case in the first half of the cycle. 2 years before the peak, it goes into overdrive, and this is when you start to see really outlandish behaviour. And the world is very much enamored of property speculation and making money and spending money. People get very excited. They start building the world's tallest building. You get pronouncements how we've reached a permanently high plateau of property prices, and people extrapolate those final 2 years into the indefinite future. And as a consequence, you start to get rising inflation. Interest rates have to start to go up at that point. I mean, they can go up before that, but it's really at the end of that when rising interest rates really start to have an effect. And then at some point, a bank will have gone over the top, will start to fall over, and that will then kick off a chain reaction, which then brings the entire banking system down.
Right. Well, plenty to look forward to then, Akhil. Thank you very much for this slide, by the way. I think this is a great little illustration. I think we can go back to our normal setup here. Yeah, there we go. And okay. So 2 years. We have to wait 2 years, Akhil, before we get the outlandish behavior. I mean, how outlandish is this going to be? I think we've seen a fair bit of outlandish behavior already, have we not, over the past 2 years?
Yeah, I bet we'll see more. I mean, I don't think you should overestimate or underestimate, human capacity for really serious stupidity and mismanagement of money and so on. I recall, for me, this was probably the worst thing. I'm sure there's many worse examples, but into the peak in the last cycle around 2007, 2008, depending on which country. And the US tends to lead the cycle, so it's a bit earlier. Most of the construction boom in the world not most of it, but the biggest sort of example of it was in Dubai. And so they built, the world's tallest building, the Burj. Actually, I just read the other day, it was called the Burj Dubai until the crash. They needed to get a bit of bailout money from the Qataris, I think. And so it got called the Burj Khalifa in honor of that. And I thought, but they were building these sort of small islands in the bay or the Gulf, or whatever you call it. Totally man-made islands. And I understand that each one, I think there were 20 or so, were going to have their own microclimate. So one was going to resemble Sweden or something. So Nordic climate. I mean, what a total egregious waste of money that is. And they never got built. I do apologize if you've got any Dubai property developers listening in. But a spade is a spade after all.
Why would anyone go to Dubai if not to visit Sweden,
Well, exactly. So none of those islands got built out, I don't believe, and a few years later they're all sinking back into the sea because that's what you need to keep maintaining such things. Anyway, so you get really silly things, and you'll get something crazy. I mean, in the late 80s, the peak in 1990, the real kind of crazy stuff was in Japan, and everyone's heard how the land and under the Imperial Palace in Tokyo was worth more than California, and there was a roaring trade in golf memberships in Japan.
Right.
I'm putting all of these little anecdotes in my book. Yeah. So the value of the trade of golf memberships in landlocked Japan, there's not much spare land in Japan. There's not really too much space for all these golf courses, but nevertheless, this is what speculation does.
Yeah.
And so the value of golf memberships, which could be traded on an exchange, I think it was called the Nikkei or the something Tobix golf memberships exchange, it was 20 billion. And, that number was bigger than all but 15 of the world's economies. So it was truly ludicrous behavior. So we'll have something of an equivalent basis in the next few years.
Must have been pretty crazy to play golf on those courses, huh? I mean, talk about privilege. Imagine the kind of people you'd bump into when you were wandering around there. They'd be absolutely minted.
They would be minted. Yeah, well, Japan made a lot of money.
I would wager that some of the people you would have met on those golf courses in Japan were behind some of the property development in Dubai, including those islands. I imagine there's got to be somebody who turns up in both of those places, and maybe they'll turn up again in whatever we see in the next 2 years' time. I mean, which leads us into what that may look like when it comes to digital real estate, which I think we can go into in a little bit as well. One last thing on the topic of outlandish behavior, I thought we could tie it in quite easily actually with the topic of land being created offshore out of by dredging up sand and creating these small islands in Dubai. It does pose a sort of geopolitical question. I think it ties in quite well with what the cycle kind of does, because what the cycle does for geopolitical relations as well. So I'm thinking of China and South China Sea. They are very much in the island building game. They are very happy to make sure that these islands that they have built stay afloat. They dredge up more sand. They've got these very nice runways on them that you can't visit them if you're a tourist, but they like these islands because they can put all these military installations on there. And I thought it would tie in quite well with what you think the geopolitical scene is going to look like in the next 2 years, because geopolitics has become increasingly important, or it's returned to importance for investors once again.
Yeah, so I mean, this is linked a bit more to another cycle that I look at called the long cycle, the Kondratiev wave. But just to relate it back to the real estate cycle, so when things are going way over the top towards the end of the cycle, it's in all governments' interest to keep the party going, keep us distracted from any kind of particular dissenting voices or things that might get us to actually look at the kind of craziness that's going on for what it is. And one of the things that you can do to create that distraction is to effectively create an enemy or stoke tensions and so on. So that tends to be, I mean, it could be something relatively benign, like putting on the games or some other entertainment, but it could be I say that because it could be geopolitical and something to do with kind of conflict. Now, related to a longer term cycle, which is also peaking in the 2020s, the long cycle, is you see this in a commodity in a wave of commodity prices, roughly 25 years up, 25 years down. Doesn't mean it's straight up and straight down, but the long term trend tends to be up and then down in those waves. And essentially what happens is, as the cycle matures, you get increasing conflict and tension between the great powers of the day. So we have the US and China at the moment, but into the previous peak in the late 70s, it was between the USA and USSR. Into previous peaks in 1920, it was, of course, the British and German empires, and so on, in previous cycles before that. And ultimately, what these conflicts are about is to do with control of trade and access to new markets, and who gets to control the way in which that trade takes place. And you're seeing all of that again with the US and China. It's, of course, you can, whether you frame it as a sort of rising power, and established power coming into conflict in the Thucydides trap or whatever. What it is ultimately a conflict over access to markets and over access to resources. And unfortunately, the point of greatest geopolitical jeopardy is in the aftermath of a real estate cycle, because when things are turning down, governments, of course, need a distraction to demonstrate it wasn't them that had caused it. And of course, to a certain extent, it was. And so creating an other, the enemy, or stoking tensions is one way of doing that. Now, when you have two evenly matched powers with web of alliances and many potential flashpoints, unfortunately, you can't manage that situation. It can get out of hand very, very quickly. So that's unfortunately the dark side of all of the things that I'm talking about.
I know this is a very hard question, but any idea on timing?
Well, I mean, it won't, the major sort of conflict and so on will be kind of after 2026, potentially, maybe the early 30s. I mean, these things don't just happen and they're not switched on and off.
No.
They take time to build. There'll be efforts to prevent it, hopefully, and maybe some will work for a time. So late 2020s, early 2030s is probably
right. And
the time of greatest jeopardy. Yeah.
Right. So it's after the big crash, ultimately.
Well, that would be how I read it, because before that, people will be very happy with how things are going, and so governments will want all that to continue, and there'll be much self-congratulation at how well they're managing the economy in the coming years.
I think it would be a good time to have a few questions. From this one, we go to...
I see there's a suggestion that I should get out more. I'll take that on board.
Well, all the lockdown rules in England have been relaxed, so we'll all be able to get out more, hopefully, in the coming months. I think I'd like to start with one that actually was sent through very early on in this episode of Southbank Live. This is from Vincent. Good evening, gents. Good evening, Vincent. Akhil, have we seen the market bottom yet? And when will it be time to start buying precious metals? So yes, in terms of the market bottom, I'm assuming Vincent is referring to the stock market. But Akhil, enlighten us. Have we seen, now that we've seen the mid-cycle slowdown during the COVID years, which will have hopefully ended by now, have we seen the market bottom?
Yeah, we're not going to go below that low, that's for sure. I don't know if they're referring to the sell-off that the US has seen in the last few days. That I think markets might retrace a little bit. I think 2022 will be a fairly turbulent year, actually, politically, economically, because there's all this sort of question mark about the trajectory of monetary policy and support for economies. And in fact, I mean, there's another cycle I look at, decade cycle, and this part of the decade tends to be fairly turbulent. So a lot of reasons why maybe there might be a lower low to where we are now this year, but it's certainly not going to be where we got to in March 2020, in my view. Sorry, was that the question, or was it something else?
Secondly, is on precious metals.
Yes,
so on the commodity cycle again. Because I know
well,
you're not massively into precious metals.
Is that a gold bug kind of question? Should we sell everything and buy gold?
Leave us alone.
I've never particularly been a big proponent of gold, other than as a commodity that rises with long-term commodity prices. And since I've said that, we are in the upside of a long cycle, so commodity prices will do well in the 2020s. I don't think gold will be the best. Personally, I think the ones most exposed to the economy, so industrial metals and things like lithium, which are clearly where the economy is going, so much more technology based. Those are the areas where you should be focusing your commodity investment. But gold could be part of that. Where gold comes into its own is when you get close to the peak, and then you get a sort of a concern about the overall existence of the financial system, and you very much get those concerns after the peak of the cycle, and gold tends to do very well in those years.
Do you not reckon that during the outlandish phase in the in 2 years' time, where everyone's making so much money that they start acting irrationally, you don't think there's going to be a lot of bling on show? Maybe it'll be a fashion to get all your teeth removed and have them, gold fangs instead or something.
Yeah, but there'll be all of that, and there'll be lavish. Actually, maybe one of the markers of the outlandish behaviour is very, very lavish Indian weddings. I mean, they tend to be extravagant affairs.
Yeah.
And a lot of bling on show. So you might hear some celebrities had the biggest wedding in world history, or something as a sign that things are really kind of going over the top.
That's interesting. I've never heard of weddings used as a top indicator, but I'm definitely going to hold on to that one big time.
I mean, there's all sorts of things. I mean, you could say. I mean, I think I wrote about this a while ago. Fancy yoga pants. The share price of Lululemon or something. That
right.
People that clearly have money to spend on £50 yoga trousers.
See, this is one of the things where I think the outlandish behaviour is already here, Akhil. I can't tell when we get into the truly outlandish phase.
But but what are you basing that on what's going on with NFTs and other things like that?
This brings us. I think we should delve into that very much, but in a little bit. There are a couple more questions I'd like to get done first, and then we'll get straight into that. This one is from Joseph. Asks a very shrewd question, I would say. Do you think that QE and other easing tools from governments to deal with the global financial crisis and COVID will affect the length of your proposed cycle? So can your cycle not be pushed off course and delayed or extended or postponed or otherwise disrupted by government actions on the policy side, on monetary policy?
Look, it's a good question. I mean, the short answer is no. Government is a player within the system, and they respond to signals in the same way the private sector does, and they all together deliver historically cycles of very consistent 18 or so years, 18 to 19 years. Now, something that is very apparent now is that governments are much more willing to intervene in capital markets compared to previous cycles. And so you tend to find that the crash is very sharp but relatively short. So what might have been a crash that lasts sort of several months tends to take place in several weeks. And some of that is because governments are, very willing to open the monetary spigots. So you tend to, you might get that kind of thing at play. Doesn't mean that the underlying problems have been solved, but for example, in the stock market, you might get quite a quick recovery compared to historically. The other thing I'd like to point out is the example from 100 years ago, so the Roaring Twenties. I think one of the questions related to that as well. Yep. So the peak of the land cycle, and this is again another reason why people really need to focus on land, but no one does. The peak of the real estate cycle was in 1926, and that is when house prices in the US effectively peaked. But what happened then was that the UK had gone back on the gold standard, ridiculous decision in my view, and the US, to facilitate that, had to lower interest rates. So money coming out of the property market with lower interest rates pushed commercial real estate and also the US stock market into two of their biggest years. And so even though the economy was getting weaker and weaker, at least on the basis of the stock market, you had two very good years. And then, of course, because you had two very good years, it came down and it didn't stop falling until 1932. So you wanted to be out. And actually, even Ben Graham, so the father of value investing, got caught up in that sort of mania of the late 20s. And actually, he was told to sell in 1930 when the market had come down 25%. He was told to sell his fund, his managing fund on behalf of other investors, and he didn't do it. So he lost a bit more than 25% in the early 30s, and then wrote his book about value investing.
Yeah. Funny how things turn out. I think to answer this chap's question ultimately, when it comes to monetary easing, in the case of the 20s, the cycle should have ended. So, or the market should have sensed that the party was over, 3 years earlier, ultimately. But government action in this case, with I think it was Benjamin Strong at the Federal Reserve, which back then was a completely different institution, ended up punting it even further, and that's why, and it became this incredible speculative frenzy. What was already a really heated market just went into overdrive. So, if we're getting to outlandish behavior in 2 years, and then we get outlandish behavior for 2 years, could it be that there is government intervention to keep the party going, and it just becomes even more extreme for a little longer, maybe 2 more years, before finally everything comes falling down?
The one rule that is, if you've invested in the markets for any length of time, is that markets never make things easy for you. And so yes, you could get something like that. You might find that actually property investments are not doing well, and in fact doing in some cases very badly. So like investors in Florida in the 1920s, for example. But in certain parts of the market, things look rosy, but they're not necessarily. And it's liable to turn around very quickly when it does happen, and you can guarantee that you won't necessarily be looking at the right things when that happens.
Right, and we shall get back to a few more questions in a little bit. It is great to see so many from the chat. Very lively chat this evening. Arthur Schopenhauer saying, "How about a war with Russia?" Well, how about it? How about it, Arthur? Just trying to imagine the man himself saying that, which would be quite something. There is a couple of things I'd like to dwell on when it comes to what we're seeing in the news recently, and whether or not this alludes somewhat to the land cycle that is sort of shifting beneath our feet, which people aren't quite noticing. Over the past 2 years, we've got all this stuff about a new normal. People are going to be working completely differently, so the rules have changed. We can't expect commercial real estate to deliver the way it did. And on that note, I would like to bring up an article from The Economist that you forwarded in, Akhil. This was taking a look at labs, the land upon which labs are created has seen an enormous boom over the past couple of years. This is Science and Technology Lifts the Gloom for Property Investors. Very interesting stats in that piece, looking at, I think it's the Singaporean Sovereign Wealth Fund, which recently bought a 40% stake in, I think it's a science park near Magdalen College in Oxford. They paid 10 times what it was worth 5 years ago. And all over the place, you're seeing commercial real estate being, people trying to alter it so you can build labs on it for all this biotech development and things like that. And it's one of those things where you wonder, it makes you see how land is still in enormous demand, even if what we traditionally would have associated its use as has changed somewhat. Even though everyone is saying with the world has changed so much, the value of land hasn't really. There's always something that some people want to do with it. Akhil, any thoughts on that you'd like to add?
Well, a couple of things. So commercial real estate tends to do much better in the second half than the first half. So it's more linked to economic growth and general kind of positive outlook and so on. As you pointed out, the way we do business, the sectors of the economy that are dominant and so on are always changing, and therefore that changes the nature of the type of real estate and where it's located each time. And it's wherever it's located is where all the kind of money goes in and where the speculation ultimately goes. So if this trend continues, and I'm not enough of a scientist to know, if you can speculate in building labs, but if they're lucrative, and if there's always there is a possibility that because we're tracking all these things, that there'll be an annual COVID jab that we take, and it needs to be innovated, and so there's a possibility of making money. So people will throw up labs all over the place, and because a lot of it is done on the basis of technology and computing power, as opposed to finding dead viruses and incubating them and so on. You could well see something like that, sort of speculative, well connected to the internet, but maybe in the middle of a northern English town or something, and that's where businesses will relocate and prices will go up. So there's always going to be something new. At the start of a cycle, it's not always easy to predict. We don't really know what kind of businesses are going to be created out of 5G, for example, but it's going to, fundamentally shake up how we do business, I'd imagine, in the next sort of decade. So that will throw up new demands and so on.
Right. It's one of those things where, new waves of technology, they fit into your cycle to some degree, right? In terms of new technical innovation, unlocking new speculative booms, that it ties in quite well, right?
It does. I mean, so the behavior tends to speculation, and it speculates in the areas that are doing well. And I think Joseph Schumpeter was, talked about creative destruction. I mean, I think he was talking about the general process of creative destruction. Whereas actually what happens at the end of the cycle is everything starts to crash and gets destroyed. And the things that sort of emerge first from that are powered by the new sort of technology, the new direction in which the economy is going. So, it was no coincidence that, the smartphone rolled out very quickly after 2009. I mean, I know it was announced in 2007, but after 2009, and at the same time when everyone became connected to 4G. And lo and behold, all these new businesses that have become enormously valuable since then have been essentially powered by that technology. So technology does take the new cycle forward. What you do, and wasn't planning to talk about this, but what you tend to find in the second half of the cycle is that technology doesn't do quite as well because it's more speculative, and so it's really led by house building and banking and infrastructure and construction stocks.
That's interesting. So we shouldn't be looking to technology quite so much in the second half of this next 7-year period.
Not
in
the way that not for the enormous outperformance that we've seen in the first half of the cycle between after 2011.
Right.
Now there's one caveat to that. I mean, it's not beyond the realms of possibility that you get Apple mortgages and you can order a modular house on Amazon. And so if they get into the real estate game, then of course that sort of changes, at least in a nominal way, it changes the thesis, but it's not really changing the thesis. Actually, they're becoming real estate speculative. They're seeing basically where the money is being made, and it's made in speculating in real estate in the second half of the cycle.
Very interesting on the technology side. I guess we'll have to wait to see, in the crash years, what comes out of that and what will ignite the flames of the next cycle to come. But I think we should discuss on the kind of technologies which may bring the cycle to a close. And you have alluded a little bit to digital real estate and where this ties in here. Vincent asked, how does speculation in NFTs and virtual property fit into the cycle? And could this be the center of the melt-up in the final 2 years? Very good question, Vincent. Thank you for that. Akhil, when people are buying huge amounts of virtual land in places like Decentraland and the Sandbox, you can buy acres of this stuff. It doesn't exist in the real world, but you can buy it, you can speculate on it, you can build things on it. Indeed, is this going to be the grand finale of this cycle? It's not even real land anymore; it's fake land.
Well, where people gather and exchange and do things together, I mean, that's land, so it can be virtual, but it doesn't replace physical land because you've got to be located somewhere. Yes, sorry, I wouldn't say the finale. I mean, it's whatever most people are doing. So if you have, a few, if not everyone is entering kind of virtual reality in Decentraland, if they're using other platforms, it might not just be one particular thing, but the point is well made. There will be general speculation in virtual real estate for sure, because we've already seen the first signs of it, and it's only really just getting started. And we don't use Decentraland in the way that we will probably in a few years' time. I would point out though that we might talk about being able to see decentral land virtually, and it kind of looks like land, and so it kind of it makes it a bit more relatable. But the internet itself is digital real estate. It's this vast new continent that is effectively colonized by a small number of enormously powerful, to a certain extent, increasingly appear somewhat nefarious platforms, and that is effectively real estate in the virtual world. And the value of that real estate is not down ultimately to, it's somewhat down to the investments they've made, but actually it's the presence of everyone connected to the internet on very fast mobile devices, and or not necessarily just mobile devices, which is a function of public investment mostly. So this is kind of why such companies are so valuable. It's a new form of real estate for an internet age.
Very interesting. Could you expand a little on that and what your thoughts are on the current environment for digital real estate, which in this case is just NFTs of virtual areas? Because this gets very easily dismissed. Decentraland itself, which has the Mana token, I believe, has been around for a long time. I remember it in 2017 during the last crypto cycle. It's still around now, but it's blown up a lot. There's actually another Economist article which featured, which I think we could bring up here, on virtual property prices. Well, let's see, virtual property prices are going through the roof. And this was somebody at The Economist noting how you could buy the Eiffel Tower and the Taj Mahal for, I believe it's $200,000 and $400,000. Though the people who originally bought them only bought them for $400 just a few years ago in I think this is Legacy, one of the oh no, sorry, it's a super world. Then this is the virtual land in which these kind of transactions are taking place, where people are recreating physical places in a virtual environment. Now, this kind of thing has been around for a while. People were playing Second Life when I was still at school, which was just a big MMO game. Why is this different? And is there genuinely any? I mean, a lot of people will say this is all just a joke, Akhil, and this is just ridiculous speculation. These are people buying Beanie Babies for ridiculous amounts of money. What are your thoughts on this as an actual item of value that has utility?
I mean, good question. So I don't know. I'm not an expert in NFTs and where it's all going. I probably should be, but I need to learn a bit more about it. So owning a fraction of a digital asset is invites speculation. Invites speculation over nonsense at the moment, sort of pictures of dogs and other things. But once you create fractional ownership of underlying assets like bits of Monaco apartment, and so on, which gives you the right to earn part of the rent of that, and if that is because that is fundamentally a scarce asset. There's only so many fractions of that same Monaco apartment that can be traded. You can start to see these virtual portfolios, and then you can start to see banks creating credit against that. It changes the entire pricing mechanism of real estate in the real world. As a result, people's behavior in terms of buying and selling houses. I mean, you might move from your central London flat into where are you, in Derbyshire, into the middle of Derbyshire, but you might retain ownership of part of your flat. You don't have to sell the whole thing, for example. You can kind of start to see behaviors which will fundamentally reshape the nature of speculation, and that I do think is potentially where it's going to go. So NFTs will definitely be part of that, if that is the way to secure title to bits of real estate. Bits of artwork. You always get speculation in artwork every real estate cycle. In fact, the record for auctions of the masters, the record is always set in the couple of years before the peak. So Van Gogh or Picasso or whatever. You might see it now on actually, to be fair, on a smaller scale with speculation and digital art. But that in itself is not enough to bring the crash. It's got to be banking related and to do with more fundamental real estate.
Indeed. For I believe it was when Lehman Brothers was going bust. At the very same time, Damien Hirst was making a boatload of money, and he had in something that was very unusual for the art world. He had actually bypassed the art dealers and gone to the auction houses directly, which is seen as very not to be done. This is very much a very arrogant thing to do. But of course, he saved himself a huge amount of money, and that occurred while Lehman Brothers was going bust. And he made an awful. It was record-breaking sale, etc., etc., etc. And that did coincide very well. So I guess we should also be keeping an eye on the art market during this period. I guess with the on the note of crazy things that are going to happen in the last 2 years of the cycle, it does feel like it could very easily be in speculation in the NFT space, or speculation in digital land. We did get a question saying, a comment saying that Akhil, your property portfolio must be absolutely enormous given your expertise on this. In terms of where you're looking on a much more practical basis, or not more practical, but less speculative than something like NFTs, etc., etc. I mean, where would you be looking? How should the everyman investor be looking to take advantage of the cycle?
So the pattern tends to be, and this is not unique to this cycle, is that the center of cities, the most important cities or regions in a country, tend to have a much stronger, from a property point of view, first half of the cycle. It takes much longer for peripheral regions or secondary, tertiary cities, or the edges of suburbs, etc., to recover out of the previous crash. And so you get outperformance of the center. Second half of the cycle, that pattern is reversed. So as people get increasingly priced out of the center of the city or the main city, they look for cheaper property and they go to secondary and tertiary cities. And businesses and things follow. So, and we're certainly seeing that this cycle. We're seeing it in the UK, we're seeing it in Australia, we're seeing it in the US, we're actually seeing it all over the place. And so if you were a property developer or investor, that's the sort of pattern that I would follow. Of course, if you are like me, a sort of fairly busy, full-time, gainfully employed sort of person, you don't really have a huge amount of time to try and identify a great spot in, say, Sheffield or Leeds or wherever, which is going to be the next property hotspot. So it really depends on your circumstances. But if you're following the property market, that's kind of the way that I would do it.
Right. I think that answers a question from Rano saying, will London property also perform well in the second part of the cycle?
Well, it will perform well. It will perform well. It just won't, you'll see much greater gains in percentage terms in a place like Northern Ireland and maybe Edinburgh or something than you will in London.
Yeah, I was in Belfast recently, and I must say the property prices there were incredibly alluring relative to London prices. You can get an awful lot
that also answers the question about the size of my property portfolio, because I am based in London, and even for someone who, I like to think I know what I'm talking about, it doesn't mean that you necessarily have the capital to build an enormous London property portfolio, I'm sorry to say.
On the on topic of land, and we do get a question on just joined, guys. Has London property reached its peak? So in the second half, it still expands, right? It still grows further, but it's just not as much, right?
Yeah. So no, we've not reached the peak.
Right.
Now, sorry, I just should say that property prices are talked about on average. I mean, it doesn't mean to say that absolutely every property in every area in London is going to go up for the next sort of 4 to 5 years. You have, property is fundamentally locational assets. You have to kind of buy a good asset, in a good location that people want to live in, at good quality, etc. Doesn't have any issues with it. But yeah, so the general point is that we haven't seen the peak in London property prices.
Do get a question from a chap who is looking to sell a rather large estate in Cornwall. Of course, we can't give personal financial advice, but Akhil, Cornish property, Cornish land, it is something that has gotten a little bit of airtime. It wasn't just due to the international event that was hosted there recently, but with folks who were born there being sort of driven out due to the gentrification of property prices and having to live elsewhere. It reminded me a lot of where folks in Hong Kong would actually be living on the mainland because they could no longer afford the house prices in Hong Kong. Any thoughts on Cornish property in general? Bullish, bearish?
No, not really. I don't have any thoughts at all. I mean, it seems to be the place that people want to be, but I think they're bringing in restrictions on various things that might continue, which might affect it. I can't sort of speak particularly intelligently about it. All I'd say is that, it seems to be the place that people want to be. So, if you're looking to sell into a rising market, you don't have to try and get the absolute peak
Right.
in anything.
Right. Well, we are getting on a little bit for time, so I think we should be wrapping up soon. I do thank everyone for the questions we've got. Robin asked, "Can't we just invade France when we run out of land?" Well, Robin, I certainly
we've tried that,
so.
haven't we? Yeah. Isn't that a running theme in English history?
Well, maybe that's what we should be looking forward to at the end of this cycle. We've got that on the horizon, perhaps. One thing I would like to close with, Akhil, just for a bit of fun, is our long-short segment. So, of course, while we're not giving personal financial advice, we do like to take a look at recent events that have developed in the markets and what our guests feel they are bullish or bearish on. What would be something they were long, one thing that they were short? So, Akhil, could you give us your long and your short, please?
I mean, I think I've probably talked about quite a lot of them. So, real estate, banking stocks. You tend to find that emerging markets tend to do quite well in the second half of the cycle, particularly because the dollar tends to weaken. If the dollar's weakening, that means the euro is going up. So the Dow or the S&P 500 tends to outperform the Nasdaq. So long the S&P, not actually short the Nasdaq, but in relative terms. Long industrial metals, short gold, for the same reasons. Yes, Joseph, the emerging markets does need a weaker dollar, and I think we will see a weaker dollar for most of the second half of the cycle. Short bonds, so you will generally see a process of rising inflation. I'm not talking about the immediate sort of short term. I mean, once opening kind of comes up, you might see some headline inflation numbers come down, but it will be generally rising inflation as there's more and more bank money created against property. And so that will be very bad for bonds. So short bonds. Long art, classic art.
The masters are making a comeback, are they?
Well, I don't know. I mean, there's people throw money at all sorts of things, so it probably doesn't really matter. just find something.
Very good. And just a couple of last questions I think that we could take before we sign off for this evening. Michael asked a very good question. Could you explain the Japanese market in terms of the cycle? The market's never exceeded to date the 1989 high. And as far as I know, that was the peak of the Tokyo land prices as well. Yeah. So, as you were saying earlier in the show, the Imperial Palace, the land beneath it was worth more than the state of California once upon a time during the peak of their cycle. But things have never recovered to the same heights that they did back then. Why is that, Akhil? And is Japan an exception to the rule, or is this just because it was so extreme that things just haven't managed to get back there?
No, Japan's not an exception to the rule. They just had such a crazy boom that they had such a massive bust that it took them pretty much the entire next cycle to sort out. And ironically, The Economist published an article on 11th of October 2007 which said the Japanese property market has had a good 2 years. It's made a comeback, which was the date at which the Dow peaked before the financial crisis. So it did have a cycle of sorts. It was really recovering from firstly the crash of the early 90s and then the East Asian financial crisis in the late 90s. Japan has somewhat demographic headwinds, but I don't really see that being a problem. I think Japan will have a pretty strong second half of the cycle, largely because a lot of its companies will benefit from new technology, robotics, AI, and so on, which are really going to power the economy of the 21st century. So I think Japan will be quite well placed. I don't ever see, though, because of demographics and because of the experience of the early 90s, that the Imperial Palace will ever again be worth the state of California. It is possible for economies to learn certain lessons, and I think that was a real trauma. So it will influence Japan for quite a long time to come.
Maybe Hawaii, the state of Hawaii. I think
Japan.
California.
Interesting. Japan bought up a lot of Hawaii in the late 80s. A lot of the buildings, the hotels, and so on were done by Japanese companies.
Yeah, there's an interesting trend of that when it came to mergers and acquisitions, where you got all of these British firms and British real estate that was bought by the Japanese, and then now that we're in, especially in the 2010s, we just saw that again, except with the nouveau riche Chinese billionaires coming over and buying lots of these things. It will be very interesting to see how that changes over time. One last question, I think. Let's see. Oh, this is a very interesting one from Bernie here. High altitude ski resort properties, potential rising market due to increasing climate change affecting low level locations. Any thoughts on that, Akhil? Any ski insights?
Well, I can't talk specifically about skis, but the point is well made. You actually saw something like this in some of the low-lying cities in America that the properties along the coast were the places to be once upon a time, but as people became more and more worried about climate change, they started moving further up into the higher parts of the cities, and which were typically areas where lower income households were. And so now lower income households are moving further and closer to the sea. So you are seeing elements of that coming out.
Yeah, I guess that'll be something something further to look forward to, I guess, or to watch out for. Look forward to is the wrong phrase, as we get further along this, because I guess that will just increase the kind of disparity between the more expensive and more valuable land and the less valuable land. But Akhil, I think we shall tie it off for this evening. Thank you so much for joining us. It has been a great episode 28. Just before we sign off, Akhil, for everybody who has been watching, who has thoroughly enjoyed your analysis, where can they find out more about your work, and tell us a bit about what's going on at Property Share Market Economics?
Yeah, so that's the place to find out more about what we write about. So you can sign up for a free blog. We've got a couple of different types of publications you can sign up to if you wanted to delve into things a bit more in a bit more detail, and you can do so on a trial basis. So you'd be more than welcome to. So the address is www.propertysharemarketseconomics.com. Our main subscribers get an annual forecast of the Dow, the FTSE, the Australian All Ords, and the NASDAQ. We provide regular updates. We show them our indicators, where we are in the cycle. And we, I think really spend a lot of time trying to help people understand how to read events in the context of the cycle. Because one thing that is very clear is that there will be a repeat of the cycle. And it's really like clockwork as well.
Well, there you have it, folks. There should be a link to Property Share Market Economics in the description of this episode. And also, Akhil, you are on Twitter, is that correct? What's your @handle? I can't remember.
It's Akhil G. Patel.
There you have it, folks. And indeed, Akhil does have a book coming out in the near future. I've been lucky enough to be privy to some of the pre-publication work, and Akhil is very humble. He won't brag about it, but it is very good material indeed. So when Akhil does release the book, we'll hopefully have another one of these episodes, and we'll be able to go over some of it and some further insights into the cycle as we go through the 2020s. But Akhil, thank you so much for joining me.
Thank you for having me.
There you have it, folks. That was Southbank Live, episode 28. Hope you enjoyed it. Thank you to all who tuned into this live, and indeed to all those who are watching a recording of it. Obviously, Thursday at 7 p.m. doesn't always fit everybody's schedule, but it has worked out relatively well for us, so we will be sticking with it. We'll be back next week with another guest, but in the meantime, hope you're having a very good time, and we'll see you in the next one. Bye-bye.